Good morning. Welcome to Friday and to the Rebel Income Insights live stream. As always, I'm looking forward to our session today and to the things we have to talk about. Before we do anything else, let me share my screen. There we go. Also need to acknowledge a little bit of an error on my end. And those of you who messaged me this morning, I really do appreciate it. I sent out the wrong, to be completely honest, I sent out the wrong link initially for this live stream, and had a couple of you message me directly through Substack, and I appreciate that. I've updated all of those links. Um, the only explanation I can give, and this is not an excuse. Yesterday was my daughter-in-law's birthday. We were watching our grandkids while she and my son were enjoying time together, and I I I sent out the post for today's live stream when I happened to have a few extra minutes uh, while my granddaughter was occupied with other things. um, and didn't take the time to double check the links that I was sending out. So I apologize for the oversight. And again, thank you to those of you who updated me and made sure that we got the correct links posted. So hopefully we will have a few more people coming in. But for those of you that are here, so excited to see you as always. Let's go ahead and dive in. Really quickly, this is today's live stream is another first. I have usually reserved this live stream exclusively for paying subscribers, and I'm shifting that a little bit, and I'm opening this up so that anybody who is a subscriber on Substack has access to to this live stream. And I'm doing that on purpose because I want to try to expand the audience that I'm interacting with. Um, so the idea here is to try to get as many people coming in. So in that vein, let me talk a little bit, just give you a little bit of an overview of the Rebel Income System and therefore the trades and things that we're going to be talking about as we're looking at different stocks in the market today. Rebel Income is a system that is set up for those of you who are already familiar with my posts and the trades that I'm highlighting on a week-to-week basis. You know this already. I'm focused on trying to generate income on a weekly basis using a put selling strategy. Now that is focused on focus first on identifying stocks that fit a certain type of criteria. And for me, those primary criteria are built around fundamental analysis and value analysis. And so I'm looking for fundamentally strong dividend paying companies. Dividends are one of the first benchmarks for the quality that I'm looking for. And then I follow that up with value. And I'm looking for generally a value proposition above and beyond their current price. And then on those stocks, I'm selling a put option. Put option is a way, rather than buying the stock outright at its current price, it gives me a way to set up a potential buy in the stock at a lower price because I sell out of the money put options on these stocks that are generally expire within 1 month or less. My average is about 17 days. So it's about a 2-week trade where I'm putting the amount of capital for one or two contracts, the price of the stock on reserve, and generating income through the put sale. So I'm securing that particular strike price and then also bringing in premium up front to generate income with. And then later on, if the method after that is rather than trying to time and exit out of the trade, is we'll talk about some rolling strategies as we're looking at some of the different open trades we have, and I'm considering different ways to manage your trades. You'll see what I mean. My method is normally to let that put option extend through its expiration date. Today is July 11th, and that there are options that are expiring today. I have an open position. We'll take a look at and consider what the ramifications for that position are based on the stock's current price. My normal method is to let that expire. If I am assigned, then I am assigned. When you sell a put option, you are giving somebody else the right to force you to buy the stock at the strike price that you sold. So one of the things you'll notice in my weekly post is that I explicitly tried to explain that the strike price I'm selling is a strike price I'm willing to own the stock at. So that is kind of a very, very broad overview and very condensed version of the way that these trades work. I publish these every single week, and I've been doing that for a little over 10 years. Hello, Jay. Welcome. So glad to see you. I'm grateful that you're here. Okay, so with that overview in place, let's go ahead and let's dive straight in. And so the apologize for a little bit of hesitation. The trade that we have on deck for this week is a put sell that I placed the last week in June. So this is about a 2-week trade, as I mentioned, 16 days in this case. Selling the $31 strike price, brought in a little over 2% in terms of income for this trade. As I mentioned, I try to keep my position sizes really, really small. My preference, as much as possible, is to work on a cash secured basis with these put sales rather than trying to work with margin. Cash secured simply means that whatever the number of contracts I sell, I try to make sure that I have enough cash available in the account to cover the potential purchase. So in the case of CPD, I sold the $31 strike price. I sold one contract. That means 100 shares times 31 is $3,100. In order to secure this trade, then I need to make sure that I have $3,100 in capital available in cash at all times for the duration of the trade, all 16 days. That is through today. If I have a portion of that 50% or so, then I have to start relying on margin, which may not be possible if you're trying to place these trades in, say, a qualified retirement account like an IRA. My preference in my cash account is to make sure that I'm doing these on a cash secured basis. So I keep my position sizes intentionally conservative. I'm also doing that as a way to try to minimize overall risk in the trade. So $3,100 is the total amount I put on reserve, brought in $65 in income. Again, that may not sound like a lot on its face, but that is about 2.1% on the $3,100 I put in reserve, which is more than enough for me to be functional and to continue to build my account, the way that I want. So let's go ahead and switch over here. Let's take a look at CPB and see how that's doing today. Remember, I sold the $31 strike, and we can see at the open here initially, market is a little bit lower. Campbell's is down a little over 1%, so it's at 30.17, not quite $1 away from the stock's current price. So it does look like I am going to be assigned. As I mentioned, that is something that I'm actively accepting when I place these put selling trades. Here's a look at the chart for CPB right now. We can see that the bearish momentum for this stock has really only just continued and been pretty strong. The downward trending 20-day moving average just continues to slope down. We're seeing continued new lows. I thought that the stock might be finding some support here a little bit above 30, around 30.50 perhaps. Hello, Barry. You and me both. Yep. but it has continued to fall. So does that mean that it is going to drop below $30? It is possible. So I'm not discounting that possibility. I don't know yet, though. I would say that this is the price action we're seeing right now is strong enough around $30 to say that 30 could still mark an important level of support. We don't have enough data yet to validate that. We have pretty much yesterday's closing price and where it is now. It appears to be trying to stabilize a little bit. Yeah, Barry, I thank you. I appreciate that comment. That's actually excellent. Says if it stays around this price, this could be very well possible to immediately start writing calls, and that's absolutely correct. If this holds, I'm still going to take the assignment at 31. Right here is this rough line is about $31. And this is the price that I'm going to buy at. And Gib, yes, when I posted the trade, $31 is a very good price for Campbell Soup based on its value proposition. So this was a trade I was very comfortable with. I still am. Jay did a buy right. So you bought the stock and then you sold a call, which is also awesome. It's just one more way to keep generating income. So there's multiple ways to do this, right? Put sell is one way, and that's again the thing that I like about that is that I get to set the price that I'm comfortable with, and I am comfortable at 31, even though it's a little bit below that now, and even though I am acknowledging the possibility that it could break down. But either way, if Barry's forecast is correct, then it is possible that there may be an opportunity to turn around and sell a covered call on this very quickly. Right now, the market is reacting to, not surprisingly, the ebb and flow of markets right now is being driven primarily by trade, and it looks like Trump administration is renewing some of their tariff talk. I was going to call it saber rattling. Whether or not they follow through on some elevated tariff rates remains to be seen. But they are that right now it's got the market a little bit on edge right now, and so we are seeing some bearish momentum in a lot of these stocks. So here is the options chain for CPB. This is there we go. Here's the strike price that I sold, 31, and we can see current bid and ask. The ask right now is $1. And just to remind you here, when I sold this put sale 2 weeks ago, I brought in 65 cents. Why am I pointing this out? Well, some of the people that follow these trades and that like to do put sales, whether they're part of the Rebel Income community or not, all of you are going to be placing the trade the same way that I do. Jay is one example. For some people in our community and some people who like to use put selling, this is a little bit of a very near bounces upwards in the stock and take advantage of those positive bounces within trends and try to capitalize on what they expect to be new bullish momentum. That also tends to mean, if that is your strategy, that if that momentum proves to be different, then you need to be willing to be very, very nimble. So the truth is that if you were following CPB for the last couple of weeks, you probably were out of this trade already. But if I were in that mindset now, looking at a potential assignment today at 31, but not wanting to take it, maybe that's just not the method that I want to work with. Maybe I don't like the expectation or the possibility that there could be more downside coming up. That is something that I might want to consider buying the option back before the before the market closes. That would cost me $1 right now. And so that means that my net loss, here's $1 minus 65 cents. So I would have to be willing to eat a loss of 35 cents on this. There's some math I can do without a calculator. So, or $35. Now, that's not a huge loss, obviously, on a net basis, but that is something to consider. And if you are of the mindset that you want to manage your trades a little bit more actively than I do, I tend to refer to my method of waiting for the option to expire and taking the result, whatever it is. I tend to refer to that as a little bit more of a passive approach. The advantage of buying this back and taking that more active approach is not only do I minimize the potential loss, it's limited to only the $35 that I would take right now if I were to buy this back, but it also eliminates the potential for the assignment. So it clears out that obligation before the market closes, takes that $3,100 that I put in reserve when I place this trade, and it makes that money available again. $3,100 minus 35, obviously. So $33,065. But that makes that capital available so that I can go ahead and redeploy it possibly with a different stock. Yes, Gib, thank you. You're giving me my segue. We are going to look at what those numbers are. Why not round the numbers and roll is what you're saying. And that is something that is a very, very distinct possibility. There may be an advantage here to doing that. This is why I say if you are if your preference is to try to not take the assignment, then there's a very strong argument for that. Again, you probably will have already done this before today. But let's just go ahead and assume that I've done that. I've closed that obligation. Now I've got my money back in my account. I can decide what I want to do next. One of the things I could consider doing is working with the same stock. Maybe I still like CPB. Maybe I just want to work with a little bit more time. So the interesting thing here, for 7 days right now, you can get about 35 cents. That's the same as the amount of loss I'd have to absorb, though. So the net result there would be about zero. I'm not in love with that. 55 cents at 30 for 2 weeks. So about 20 cents to the positive. And 70 cents for 3 weeks. This is a little more interesting. If you wanted to go even more conservative, you could do 35 cents for the $29 strike price. This one's a little bit more interesting because it would still give you a net of a little over 1% if this option expires, if you're not assigned at 30. And if you are, then it is giving you the possibility of thinking about a lower purchase price as well. If you're in as Jay is, where you did a buy right and you're already owning the stock, then you need to be watching the momentum on the chart and trying to decide what you want to do with that position. I do like the way that it is stabilizing just in the last few minutes as we've been talking about it here. Again, we'll see if that continues to hold, but owning the stock means that you're probably working with it at a little bit higher price than the one that I'm using in my example of $31. So you have to decide what that means. The covered call in that case is decreasing in value. Okay, Jay, thank you. You're in at 30.77. Perfect. And tell me which, just again, so that we can compare numbers. What strike price did you sell for your covered call? And what expiration, by the way? Was it today's expiration? 32. Okay. For 24 cents. Okay. What's your expiration date then? July 18th. Okay. Thank you. So next week's expiration at 32. The ask on this right now is 15 cents. So you went out a little bit more time. You went a little bit further out of the money, try to bake in a little more capital gain, right, by selling a little bit higher strike price. So you sacrifice premium for the capital gain, which is totally fine. It does mean right now there's a lot of open interest on this one. Hasn't been any trades yet today. Thank you, Jay. I'm glad I read you right. Seen enough of the trades that you have done by comparison to mine. I think I'm getting a little bit of a feel for the way you like to do these, which is I love. Different strokes, man. So you know yesterday's close here was about 13 cents. The ask is about 15 on this right now. So that's interesting. I don't know. If you bought that back, you'd keep about 9 cents of premium. Be hard to justify. Well, 20 cents at 31.50. Kind of depends on how much gain you're looking for. Might just be smarter just to always, yeah, you can always roll it. Be honest, I don't see a whole lot of reason not to just hold the contract you've got right now too. See what happens in the weekend. The other thing you can also do is consider lowering your strike price. Instead of at 32, if you wanted to buy back, you could think about going to a little bit lower. At 31, you still have a little bit of capital gain. There's a little more premium. None of these are recommendations to buy or sell, as always. Got to keep that coward's door swinging. But there's one possibility. 20 cents here at 31.50. So you're still giving yourself a little more capital gain that way. And Jay's gonna wait. So I think you and I are in agreement. Makes more sense just to stick with the contract you got for now, which is okay. Nothing wrong with that at all. All right, awesome. So that's CPB. That's the contract that we're looking at for today. As things stand, I'm gonna let this play out. I like the stabilization, even though it's below my $31 strike price enough that I'm not afraid to take that assignment at 31 and see what else happens from there. Doesn't mean, again, you've got to, if you're going to be accepting an assignment on a stock, you've got to recognize the potential for that extended downside. And you have to actively decide that you're okay with that. If you're not, you may be okay with buying with holding the stock for a little while. One of the things that I don't do actively, but that I've had some people ask about, is putting a stop loss on a stock after an assignment. And that is one way that you can limit your potential downside even more. I tend to let these trends play out. If I like the stock at 31, for example, even if the stock's downward trend continues, it drops down into the 20s. I usually am willing to play the long-term investor card here and let that play out. This is one of the reasons that dividends become such an important part of my system. It's not just about the fundamental quality and the improvement that lends to the overall fundamental profile. Holding a stock means that if I'm still holding it when there is a dividend distribution announced, that means that I get to bring in those dividends as well, and so it gives me additional income above and beyond what I'm able to generate through covered calls or through my put sales, where that give me those occasional assignments. Every little bit of income helps, even if it's only once a quarter. You can see the distributions right now, 39 cents per share per quarter, so a little over 1%. That translates to a really useful dividend yield right now of almost 5%. This is one of the reasons that you see me write in, if you read my posts on Substack, you see me write about equity bonds. So I'm looking for stocks that have a fundamental strength to them, a fundamental quality. It doesn't necessarily mean they're immune from the downward pressure that the market can put on everything, especially when economic conditions are kind of shaky and uncertain, which we're looking at right now, and seemingly on an increased level if tariffs are increased on countries like Canada and Brazil and some of the others that are making the news right now, not to mention China. If those things continue, we can expect continued economic pressure. That is probably going to keep the market on uncertain ground and very possibly bearish for the time being. That means that these stocks can very well continue to go down, but these dividends that they're paying also make them make them comparable to, say, a lot of treasury yields right now. Certainly, you're in the neighborhood of the 10 and 20 year treasury bond yield at 4.99%, and this is on a stock that has the possibility of a faster recovery than what we will typically see with bond prices under the same kind of conditions. Take a little bit more volatility, but you're still getting a comparable level of income with the possibility of greater overall upside in the long run. So Campbell's and Hormel is another stock I've been holding for a little while. A lot of companies in the food products industry, a number of others in a lot of other industries right now are fitting this description that I have of an equity bond, a stock that you can consider is kind of a replacement, a proxy, for lack of a better term, to treasury yields. Again, it doesn't mean that they aren't immune from what market is doing. You have to still work with that understanding. But when you're looking at yields in this neighborhood on individual stocks, you have to start considering their value against some of these other more traditional flight to safety type of vehicles. And the flexibility, the improved functionality they give you in terms of rallying if conditions return to being mostly bullish. Here's a quick look at the index. This is the S&P 500, just to try to paint a little bit broader, big picture view of things. We're coming off of the latest all-time highs up here, right? This was just yesterday, in fact, up around, what's this, probably close to 6,300. So the S&P 500 is coming down a little bit off of that. Hardly enough yet to call it anything more than a drawdown, to be completely honest. And there's still quite a bit to go before we really need to talk about any kind of correction. This could just be a one-time kind of a thing. The 20-day moving average is right here. This is the orange line, but the closest I have on my drawing tool is yellow. This would be expected to provide support. Right now it's around 61.33, a little over 100 points on this one, so we'll see how that plays out in the broad market. But that pressure is going to translate to every other stock in the market that you might consider, including Campbell's. Okay, let's go ahead and move on. Let's take a look at some of the other trades on deck. As I mentioned, this is the only one that I have set for expiry today, is the put sale on Campbell Soup. I do also have a put sale coming up next week on Skyworks. So let's take a look at that one really quickly. For context, I sold the 67.50 strike price. So this is a higher stock price. This means that even trying to stay conservative, I only sold one contract. Again, this was a 30-day trade, rather. I placed this the week before on the 18th. Brought in right at 2% on this at $1.35. Working with a higher strike price means that obviously the capital that I put in reserve is also higher. I still only sold one contract, so I'm on the hook for 100 shares. But to put that in practical context, 100 shares times 67.50, $6,750 is the capital that I have to have on reserve in the account if I want this trade to work on a cash secured basis. Anything below that, then I need to make sure that I have enough margin available to help me cover it. Again, my preference here is to work on a cash secured basis whenever possible. So this is why right now I'm not selling more than one contract on this. 67.50 is kind of the upper range of what I'm willing to work with in terms of position sizes right now. And the way, just to be clear about the math on these, here's 67.50. Let's just divide that by size of the account, 290. I'm going to call it 297 since it was a little bit above that when I placed the trade. So this was 2.27% of the total account size when I placed the trade. I'm trying to limit my exposure in any one trade here to no more than 2 to 3%. And if I can be closer to 2%, I like that a little bit better. So this is well within that range. That also means that the upper limit of where I want to be, 298, since that is the account size now, I divide that by 0.03. Excuse me, multiply, sorry. 1, 2, 3 times point. This is why I don't do the math in my head. There, still divided, sorry. I can type 298. Times 0.03. There we go. So right now, $9,000, just a little bit shy of $9,000, is really the maximum position size that I am really looking to take on in any one trade. This is why you don't see me really toying too much with stocks that are above about $80 per share. Starts to stretch my math just a little bit, and I'm trying to stay conservative. Okay, let's check in on Skyworks. Let's see where we stand. All right. So the story is quite a bit different on this one than what we were talking about on CPV. My strike price is right around here. Here's 67.50. Sorry for the ugly handwriting. And the stock is clearly showing a nice upward trend since April. Even with a little bit of a pullback here the last few days, we're still sitting at about 75.88. Now, with a week to go to expiration on this one, Gib and everybody else is talking about what about the possibility for rolling. This one is going to have a different profile, isn't it? So let's go ahead and take a look. Have a lot of flexibility with this one. because of the way the stock has accelerated past that 67.50 strike price. That was out of the money just a little bit when I placed the trade a month ago, well, 3 weeks ago, excuse me. And this is a stock that does not offer weekly options. You can see there's next week's expiration, and then from there, you have to go out another full month. So 35 days, a little bit over that right now. But here's the 72.50, 72.65, excuse me, 67.50 strike price that I sold. This asking price is obviously a little bit out of whack. That is going to be primarily because of the distance that the stock has moved from a strike price. It means there's likely been very little activity on this contract. We have 125 contracts in open interest, but no real activity. And the last trade on this is interesting, was back on the 3rd. So this hasn't had any contracts change hands in a week. And that tells you something about the reason that this asking price has been as sticky as it is. Still some open interest here, about 314 contracts sitting here at that asking price. Previous close was at 17 cents. So what does that mean for my contract? Again, I brought in $1.35 on this. I am not, if I'm thinking about buying this back and trying to decide whether or not I want to roll, I'm not going to take the same asking price, right? There's no way I should have to do that. There is enough open interest here that I could probably take this previous close as a reference point and put in a buy to close order, a limit order for possibly 20, 25 cents. Maybe I go down to 17 if I'm willing to wait for the market to come to me. But if I probably went around 20, 25, there's enough open interest here that there's a fair chance that that trade would get taken. Maybe not right away, but that would free up the 67.50 that I put in capital, that I put in on reserve, excuse me, the $6,750, and give me a little bit more flexibility. Maybe I would only keep about, in that case, a little over $1 in my total premium. But for those of you who are familiar with rolling strategies, anytime you can keep more than 50% of your premium, you're usually sitting in a really, really nice spot. There are members of our group here who, if they were here today, my friend Joe and a few others, if they were looking at this, they would be screaming at me, "Why aren't you doing this right now?" And that's fair. The next question, of course, is what do you do next? Now, the interesting thing is, because I'm so far out of the money, let's say that I did buy this back, I'm just going to throw out 20 cents. I did a buy to close at 20 cents. Let's suppose that was taken. I could turn around, continue to work with the same expiration, and still go with a pretty conservative trade at 75. The stock at 75.82, and it has pulled back, so that's one of the reasons that this is looking a little bit interesting. But at 95 for the $75 strike, they're generating a little over 1% for 7 days. The same expiration, but now you're adding an additional little bit. Let's see. 0.95 divided by 7.5, 1.26% for 7 days. Again, not a recommendation to buy or sell, but that's, again, intriguing at the very least. I have to give up a little bit of premium to do that, but then I can turn around and if I'm willing to work with this at a little bit higher strike price, the value proposition is still pretty nice, even at 75. So we'll see. Guess what I'm going to do? I'm going to hold it. I'm not going to roll it. I'm going to let this play out. And obviously, I've got quite a bit of a buffer here. And the primary reason for that is not necessarily that it's not that I can't find other things to do with the same capital, right? There's a lot of stocks right now that actually look pretty nice. It's really about what is more functional for the way that I like to manage my system. I purposely prefer to be a little bit more passive. Let the result be the result. If I'm assigned, I'm assigned. If I'm not, that's fine. I let that trade play out for its duration. If I'm selling 30 days, I will typically wait the 30 days. I'm actively giving up some of the income opportunity that is available for more active rollers. I'm also, by doing that, relying heavily on my probabilities. A lot of the people, just to kind of illustrate the difference, let me show you my summary here. This was as of towards the end of June, and I updated all of my numbers. My success rate on these trades is about 98%. That means that not necessarily that I'm avoiding assignment 98% of the time, but the overall result of my trades, 98% of the time is a net win. If I take an assignment, that means that eventually I'm able to get out of the stock at a net win 98% of the time. That's counting trades where the put option just simply expires worthless as well. I'm relying very, very heavily on that success rate, and that's one of the reasons that I let this play out and I wait until the expiration date. If your preference is to be a more active roller, you're going to have a higher trading frequency. You're going to be placing more trades than I do, and a higher trading frequency generally means that you have more income coming in. So you're expanding the compounding effect on your account. That's one of the reasons that rollers, some of the people in our group who prefer to buy these options back before expiration and then redeploy the capital, whether it's with the same stock or something else. It's one of the reasons they prefer this. One of the primary reasons, to be completely honest, is you have that opportunity to place more trades. Trading frequency increases the compounding effect and improves your overall returns. The flip side of that is that the probability goes down. Not a ton, but it does go down. As I've surveyed some of the people I know that have been more active in rolling, the probabilities for them are usually between 75 and 80%. Now, to be clear, a 75% chance of being successful and of winning sounds really, really amazing, and so does 80%. So that is nothing to spit at. But it also means that you have to be willing to accept the fact that sometimes, for example, like with CPB right now, you would have to absorb a little bit of a loss. And that's going to happen more frequently with a rolling strategy than with what I do. So I lean very heavily into that probability, and that's one of the reasons that I let this play out. Okay, I hope that helps. Let's move on. Let's see, the next ones that are coming up include a put sale on Pfizer. This was from the beginning of July. On the 2nd is when I placed this trade. So last week, selling the $25 strike price, bringing in 60 cents. Barry, I have to agree with you. Yes. Stocks like Paramount are in the 2%. So 98% winners. This is a loser. Technically, not totally, because I still have it. It's an open position. But this was one of those, if you remember the meme stocks, this was one of those that, 2021, 22, saw some big movements from meme type trades, and has since dropped into a very extended and pronounced downward trend. Lost a little while, it's rebounded a little bit, but I'm still in this at a much, much higher price. And yes, this is one that is going to, will very, very likely ultimately go down in the loser category. But it's also still paying. They've had to cut their dividends, but they're still paying a dividend, which is about 20 cents per share per year. And the stock's current price, that's still pretty attractive. So, yeah, they keep on extending the merger deadline. Almost ready to opt out and start selling calls. Yeah. And Barry, you are in it much lower, certainly much lower than I am, in the interest of full transparency. So, but yes, there are stocks like this where it's in extreme downward trends. And again, there doesn't mean that you don't have losses, but you try to minimize these a little bit more when you have them. This is one of the more ugly ones, I'll be honest. So we'll see where Paramount goes. Okay. But again, this is a Pfizer. Remember, I sold the $25 strike price on this one. Barry, you're above your average cost, so that's awesome. You've been able to play out Paramount quite a bit differently than I have, so that's a big tick mark. You get a big win on that one relative to me, so that's awesome. For Pfizer, I sold the $25 strike price, brought in 60 cents. This is another stock that I'm in at a higher price. And so in this case, when I placed this trade at 25, this was an opportunity for me to leverage the stock's downward trend. Let me expand this a little bit. Goes back quite a while, all the way back here to December of 2021 is when it topped out above $60. That's a pandemic-driven high because its COVID vaccines were so popular, and that provided a big boost to their bottom line. That downward trend has come as those vaccine sales have tapered off, and they've had they've become more reliant on their traditional pipeline, which is very robust and very successful, but the market is pressuring the stock. So this for me is an opportunity to take the put selling concept and expand it a little bit. Sometimes with stocks in these extreme downward trends that you've seen a protracted decline from the price that you bought them at. Sometimes these set up opportunities to sell additional puts at a much, much lower price. And if you take a new assignment, you have two different purchase prices, your original one and the new one, to average together. My original cost in this stock, to be completely transparent, is about $50. Let me just double check my numbers. Sorry, just a sec. $55, excuse me. So my initial purchase price on Pfizer was at 55, again, at a much higher price. It was back here in 2022. Thought that it was topping out at that point, and I was wrong. Now with it down here at 20, in the neighborhood of above 25, if the stock does drop back below 25 and I take a new assignment on this, then that gives me an opportunity to average those two numbers together. So 25 plus 55, that's $80, which means I only sold one contract the first time, so I sold the same one contract on Pfizer this time. So that's potential for 200 shares. So obviously, excuse me, 800 times divided by 2 means my average cost would go down to $40. That becomes a little bit easier to manage relative to the stock's current price than 55. It's still quite a bit higher. Barry beat me on income. And just talking about the $25 strike price, brought in 75 cents versus my 60. So here's your big one, and then I'll give you a little one. It's also ended at 28. And yeah, it doesn't hurt your feelings. Take the 2%, the 6% yield. Again, the dividend on this is very, very useful. 6.5%. And to be clear, this if you're using TradingView as I am, this is an interesting little graphic here. Makes it look like the payout ratio relative to earnings is very, very high. Relative to cash flow, not so much. It's actually still pretty conservative. So their payout ratio is actually a more shielded than this would make it seem. And they do have a new earnings report due on the 5th of August. So coming up in not quite a month. And their next dividend, 43 cents, coming up on the X date is the 25th. This trade for me expires on that date. Which means if I do take an assignment that's on 200, that will add another 100 shares to my position. So the dividend distribution will effectively double, which, like you're saying, Barry, that doesn't hurt my feelings. And that has been one of the primary reasons that I've been working with just holding on this stock through this downward trend, is these dividend distributions have been very useful. My net cost, if you want to talk about averaging plus all trades together for Pfizer, I've been able to do a few covered calls and a number of put sales in the amount of time that I've held this stock since 2022. And as a result of that, along with all of the dividends, I've been able to bring in almost $5 just in dividends alone. My net cost basis, when you count everything from premiums from put sales, covered calls, along with the distributions from dividends, my net cost basis is around 45 right now. So almost $10 below my actual purchase price. That also means that if I do take a new assignment at 25, my net cost basis drops down to about $30. Which again changes the profile of what that stock looks like to me. This is one of the reasons some of these income strategies are so effective and so useful, even in stocks and downward trends. That doesn't, I'm not pointing that out to say that this means that I'm a brilliant investor. I've been sitting in a stock as it drops all the way from 55 down to 25. So you can think whatever you want of that. This is just one of the things that I've been able to do to manage the position that has helped me keep some of my objectivity about what the company is actually doing. I hope that makes sense. Okay, so that is Pfizer. Thanks to those of you who come in the last little bit. I appreciate it. I'm certainly happy to see you here. The other trade for next week is a covered call on Mosaic. This is another stock that I've been holding on to for a little while, and was able to sell the $38 strike, bring in about 2% on that covered call. So let's check in and see how this one is doing. The again, as I mentioned, I'm in on this stock at a much higher price in terms of my initial purchase, but as a result of dividends, as a result of covered calls, being able to sell some additional put sales, I've taken one or two assignments on this. My net cost is a little bit below 38. So this covered call that I have placed on this one with the $38 strike price means that I'm coming out right about even if I get called out. Right now, if I had to guess, it looks like I might not be. But what we're also seeing here, this is a stock that has rallied from down around 22 in April very, very sharply to its latest peak at around 38, which is right where my covered call is. That also means that this latest drop, here's the peak. We've been dropping off of this since then. This latest drop is really just kind of consistent with a pullback within a larger upward trend. And in fact, if I'm going to change my line here a little bit, let's just connect these. Look at this. We've got a higher low, and what looks like it could be a higher low. So you connect those, you get a little bit more gradual upward trending slope than what we have from the stock's momentum since April. So this could just be a little bit of a normalization going on, a little bit of consolidation even up here at the top end of this range for Mosaic. I'm okay with that too. Consolidation ranges aren't a bad thing. That just means that the market is taking a little bit of a breath, taking another view, and deciding what it's going to do next. It could drop back again. It could push back up above. I don't know yet. This is another one of those companies. Again, when I sell a put option on these, I'm actively saying that I'm willing to hold the stock, that I like it at the price that I am being assigned at. So with my net cost on this at around $38, I'm pretty comfortable. Not just right now, but even if the stock were to drop back again, it's just going to give me another opportunity to find some interesting new ways to work with the stock. I'm going to try to take those very, very carefully. I'm going to try to consider those possibilities very carefully. Remember, talking about position sizing, one of the strategies that you can do if you're willing to do something like what I've been doing with Mosaic, which is to sell additional put options, just like I'm doing with Pfizer. Think about what your total position size, your maximum is willing to be. Under broadly bullish conditions, the best, most transparent conditions possible, the upper limit of my range is about 5% of my total capital. So that means on 298,000, I multiply that by 0.05, my maximum position size is about $15,000. One of the things you can do is break that up, whatever that maximum size is. Maybe on your initial put sale, especially since these put sales are being done, if you're following them the way that I'm doing them with Rebel Income, remember I'm selling into downward trends, and we're out of time, so we're going over a little bit, but I hope this makes sense. So I want to try to emphasize this for a little bit. We're selling put options into downward trends. Barry, you're going to get called out of FCX. So let's go ahead and check in on that one. Nice, 46.18. I like it. Barry wants another tick. Big, little, little. There you go. Okay. MOS, that's where we're going. We're selling put options into downward trends. That does mean recognizing the possibility of more continued bearish momentum. So when that is the case, when that happens, one of the things you can do to be more conservative is to stagger your put sales. Instead of selling the full position size, if I'm working with Pfizer, for example, let's go over here to this one. And it's around 25.56. You know, instead of at 25, 14,900 divide by 25. Okay, that's almost 600 shares. I'm going to round that down to 500. That's possibly 5 contracts in one go if I wanted to sell the full size. If my total limit of exposure is 5%, I could sell 5 contracts on this. If I wanted to be more conservative, I could break that up by selling, say, 1 contract, for example. I'm going with a much lower position size. I'm not bringing in as much premium, right? So, but I'm also not committing as much capital into the account. It also opens up the possibility, maybe I cut it in half. Maybe I'm only doing 2 contracts. Maybe I'm doing 1 contract. Whatever the number is, what you're able to do is you're able to build in the potential for tiers, or what I've heard, what some of the people in my group like to call tranches. Where if the downward trend continues and drops, say, 20, 30% below the price that you were assigned on the first tier, then you can consider selling another put option. And you maintain proportionality. So if I only sold 1 contract initially, I sell 1 contract again at the lower price. That proportionality keeps the math simple, but it also keeps my tiers in place. So if I have 2 or 3 or 4 tiers possibly built in, that gives me a lot of flexibility to manage a downward trend. All right, and Barry, going back to FCX, and we'll wrap up on this one. On this note, assigned at 41, brought in 90 cents on 623, and you got a nice movement here to 41.50. So you've got a nice gain there along with your premium. So, and 70 cents for SLB. That's one that we've got on deck for next week as well. For 36 strike, made that trade on the 8th. Awesome. Barry, great job. Nice results. 1, well, that's got to be a big one. 2, 3, 4. There you go. These are awesome. Great results. Love it. Appreciate that. Everybody, thank you so much for your time. Really, I've enjoyed this session. I like this idea of just trying to keep this public and invite as many people as possible to come in, and feel free to share the result with everybody, with anybody else that you know that may have an interest in what we're doing. I'm going to be keeping this freely available in public as much as I can and as long as I can. Barry, no updates on NVDL. Well, that's okay, right? We established last time. You'll wait around for that one. So there will be another opportunity. Picking up some bearish momentum right now. So maybe you wait. Awesome. Finance Forever, thank you so much for your time. Really appreciate everybody being here. Hope you have a wonderful weekend. If there are any questions, if anything comes up, don't hesitate to let me know. John, thank you. Thomas, I hope everybody else has a wonderful weekend. I got to spend some more time with my grandbabies. We're not done celebrating a birthday for my for my daughter-in-law. So we still have some other plans. We're looking forward to it. So everybody, thanks again. Look forward to next week. We'll talk to you next time. Yeah, thank you, Barry. Talk to you later.